Greece's debt burden is enormous. The figures for 2015 alone are staggering. Since January, it has paid more than $17 billion to its lenders, but that's not even half of what it's scheduled to pay for the year. Upcoming payments through to December add up to another $20 billion, and the country owes a total of $366 billion to the so-called Troika, the Eurozone, the European Central Bank, and the International Monetary Fund. CNN's emerging markets editor, John Defterios, joins us now from Abu Dhabi with more. And John, this is unprecedented for Greece. The Greek Prime Minister is calling for calm. How will this play out tomorrow?
Well, there's things to watch here, two key reactions to watch, and the first is unfolding in Asia. Candidly, a correction of 2 to 2.5% in the stock markets is bad, but it's not catastrophic. We've seen the same sort of correction with regards to the euro against a basket of currencies. Again, it is a sell-off, but it's not a run on the euro as we can see it today. More importantly is to watch the reaction on the ground in Greece, and this report touches upon that. But after successive bailouts, Lynda, going back to 2010, we've seen different reactions. At times during the elections, for example, we saw protests. We saw strikes at the ports, strikes at the airports, which would hurt, of course, the tourism sector. In fact, Alexis Tsipras, in his address to the nation last night, was calling for calm, but he, at the same time, suggested that EU officials were using, in his word, blackmail yet again. But he said the reaction by the Greek people to remain calm is important. Let's take a listen.
The deposits of citizens in Greek banks are absolutely secured, as are the payments of salaries and pensions. Any difficulties which may appear must be dealt with calmly and with resolve. The calmer we deal with difficulties, the sooner we can overcome them, and their consequences will be milder.
This is a government, Lynda, that was absolutely against capital controls, including the finance minister who was tweeting yesterday that it goes against the spirit of the monetary union, in which we have 19 members. These are severe capital controls, limiting Greek citizens to 60 euros a day. That is very, very constrictive compared to what Cyprus did back in 2013 with the cooperation of the European Union on that bailout. By the way, the capital controls there lasted for 2 years. Right now, at least, we know that the stock market will likely be closed for a week, and these capital controls will remain in place. Banks close until after that referendum on July 5th. And then after that, it's anyone's guess at this stage.
And John, with people unable to access the money they need, spending will be down. The economy there is already weak. How bad could it get?
Well, this is a country that's gone through what I say is not a recession, but actually a depression. You have to go back to the 1930s to see something of this scale. They've lost a quarter of their economy in the last 6 years alone. It's $100 billion of GDP. And to strike it home to some of the vendors that Issa was speaking to there, per capita income has dropped $10,000 a family. It is unprecedented. And we've seen a contraction in the first quarter of just 0.2%. That's nothing compared to what we're likely to see in the second half of the year. The businessmen I've been talking to over the last week are suggesting we could see a contraction of another 4 to 5%. What does that mean? We have unemployment of 26%, much more than the countries of the Arab Spring that have suffered over the last 4 years, and it's not likely to turn any better. And the other thing that's forgotten in this debate, Lynda, which I think is very important, you talked about the level of debt, $366 billion in the bailout package, 177% of GDP. Even if the Greeks stay in the euro, it doesn't solve that problem. It is a failure of the Eurozone after a very short life of 15 years, 13 years for the Greeks to potentially leave the euro after such a short period of time. The structure wasn't right from the very beginning, and the Greeks are paying a very severe price today with a lot of uncertainty in other countries as well.
Tough times certainly will continue. John Defterios, thank you very much for joining us. And our senior international correspondent Ivan Watson is live in Beijing. He joins us now with more on how the Greek crisis is affecting the markets as trading opens in Asia. And clearly, it's already entering negative territory.
That's right. All the markets, major markets in Asia are down in the first half day of trading, 1 to 2%, and perhaps the one that's suffering the most right now, the Hong Kong market. And I've been talking to analysts to see whether they think that Asian investors are worried right now, whether they fear that there could be a threat of contagion, that this could spread much further than Greece. Here's what an analyst from HSBC had to say.
That's always a risk. We already see currencies in Asia coming under pressure on the back of the announcements that we had in Greece over the weekend. And as the week progresses and we get closer to a potential default by Greece, for example, investors will reevaluate their positions in emerging markets, including in Asia. So some economies in Asia are more vulnerable than others. But it is clear that this will be a very volatile week for global financial markets.
And nobody really likes volatility, and that is not a way to really make money and value. And that's something that I think everybody is waking up to this week. Lynda.
No doubt. And of course, stock markets in China were already plunging over the last 2 weeks. Could we see that accelerate if Greece defaults?
Well, that's an important question. China's stock markets have really been going through major sell-offs over the course of the last 2 weeks. They've lost more than $1 trillion worth of market capital in just the last 2 weeks. But the interesting thing, the unusual thing about the Chinese stock markets is they are very insulated from the rest of the world's stock exchanges. That's because of strict capital controls here, because of the fact that it's very difficult for foreign investors to invest here in the Chinese stock markets, and also difficult for Chinese investors to put their money in stock markets throughout the rest of the world. So the downturn that you've seen in the Shanghai Composite, in the Shenzhen Composite over the course of the last 2 weeks is largely a domestic phenomenon. And I was incorrect earlier. It's actually these two markets that are down most in Asia, with currently the Shanghai Composite down more than 3.5%, the Shenzhen down almost 6%. It's important to note that the Shanghai Composite is still up some 30% over where it was a year ago. These two stock markets were witnessing some of the most spectacular growth seen anywhere in the world, but that's also part of the danger. It attracted a lot of so-called mom and pop investors. This is taxi drivers, housewives, teachers, students, some of whom were borrowing money from banks to invest in what seemed like a surefire win. And these people are suffering the most right now as the Chinese market has been going into these downturn. I've personally seen some really unhappy faces, and we're seeing again sales in the stock markets, despite the fact that the Chinese central bank cut interest rates to record lows over the course of the weekend. We'll be following this closely. Lynda.
Excellent. Stay on it. Ivan Watson in Beijing, thank you very much for that update. And you, of course, can follow all the developments in Greece on our website. CNN Money has details about the Greek government's efforts to assure people their money will be secure and the ongoing standoff between Greece and the Eurogroup. That's all at money.cnn.com.